Well, we're halfway through 2020 and we've experienced a crazy time as an investor. We've seen a lot of volatility on Wall Street. Do you change your investment philosophy? Stick around, you'll find out exactly what to do in times like this. Welcome everyone. Show's called Your Money or Wealth. Good to see everyone here. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. This show wouldn't be a show without the big man, Big Al Clopine. He's sitting right over there. And when you look at today, if you look at the markets themselves, we saw the biggest bear decline, the fastest bear decline in the history of the stock market. But now we're seeing some recovery. But we're only halfway through the year. What's going to happen? That's today's Financial Focus. In the short term, volatility in the stock markets makes us do the wrong decisions, right? We get a little bit scared, we get nervous, that fear sets in. But if you look a little bit longer term, even in the worst cases in market history, things recover. Let's take a look at the Great Depression back in the 30s. If your stock allocation stayed invested, you would have made 367% over a 5-year period. Or how about a recession back in the 80s, 267%. And then here recently with the Great Recession, 178, almost 200% over a 5-year time period. So I understand things get scary when markets get volatile, right? But you have to make sure that you have the right plan in place. And to help us start that foundation, let's bring in the big man, Big Al Clopine.
Probably the most important thing that you can do in volatile markets like we're having right now is to control your emotions. I know that's difficult, but you tend to make the wrong decisions in volatile markets because of fear. And so we'll go over some strategies there. Second thing you want to look at is managing your risk. Make sure you've got the right portfolio for these times. We'll spend a little time on that. Don't forget that there's some great tax planning opportunities, mainly tax loss harvesting. That's key at times like this to end up reducing your taxes. And finally, in the last segment, we're going to talk about investment moves that you want to make today. And Joe, I think the fact that it is a volatile market, people really do get afraid. And when we're fearful, we tend to sell, don't we? Because we don't want to lose our portfolio.
Well, sure. I mean, you see your account balance dropping by the thousands. And especially as people get closer to live off of those assets, I mean, that's human nature. When a train comes towards you,
you try to step out of the way.
You try to step out of the way, and that fear steps in. And this is from our buddy Carl Richards, right? So when you look at here, this is when we buy when markets are high because everything is good. You look at the news, it's like, well, nothing can go wrong. Right? But then all of a sudden the market starts tanking and then all we do is watch the news and all you hear is this bad news. It's crazy. So we get fearful and then we sell. And then the market recovers and then it's like, oh, I guess everything is good again. So then we purchase. This is a great recipe to go broke. But we consistently do this all the time because of our emotions. That's why having a game plan is so key and making sure that you understand that markets will move, markets will be volatile. But the biggest, I guess the problem is that this time will be different now. This time will be different. And you feed all of the news from the media. And I don't blame people for doing this.
Yes, and part of the reason, Joe, why this happens is because there's been many studies that sort of prove this out, is that the fear that we feel is probably twice as much as the elation that we feel when markets go up. So when markets go down, we're twice as fearful. The emotion is twice as strong as when markets go up. And Joe Carl, I think, does a good job with that as well.
Yeah, I mean, we're twice as fearful to lose $1 than we are to gain $1.
Right.
Right. We don't necessarily want to lose. Making money is great, but losing money hurts twice as bad.
Right.
And that's why there's this behavior gap, because there's an investment return, right? What is the overall market doing? What is your mutual fund doing? And then what are you doing, or what is your actual rate of return in regards to the portfolio? Dalbar does a study. If you've watched the show any amount of time, we've shown you the studies that the investment return of the overall investment is significantly higher than the investor's return. And the reason for that is we're buying and selling at the wrong time. So this is the behavior gap. It's our behavior when it comes to our emotions and how we're getting in and out of the market. We all know this. This is not rocket science, right? I can tell you, don't sell when the markets are going down. But when the markets are going down and you hear that from me, what are you gonna do? You're gonna sell anyway because you can't help yourself. I get it. Planning is key, Al.
Yeah, I think so too, Joe. And part of, I think, getting educated on this is taking a look at a little bit of history. Because like when you look at the S&P or any index for that matter, over the last 10 years, it's done rather well. And I think what tends to happen is we focus on what's happened the last couple, 3 months. And yes, it's been tough, although we've received some recovery. March and April 2020 was not very good at all. But if you look at that, Joe, in terms of how the market has done over the last decade, it's a completely different story.
Right. I mean, I think we've all seen these charts too. It's like, well, if you look at the long term, it trends up.
Right.
Right. But, you know, these little blips that we see, here's 2008, we all remember that, don't we? And then all of a sudden we had this nice ride, and then we get stuck with 2020, right? We all know what's going on now. There's really not a lot of good news. And we're going to see a lot more volatility in the overall markets. There's no way around it. There is no way around it because we don't know what's going to happen in the future. So we got a great guest today. We got Brian Perry. He's a chartered financial analyst. He is the director of research at Pure Financial Advisors. When we get back from the break, I want to sit down with him. I want to ask him questions. What should we be doing now with our money? Should we change our overall investment strategy or philosophy? Should we get into certain sectors? Hey, maybe we should look at healthcare, maybe biotech. Maybe we should just buy the things, Facebook, right? Maybe Amazon, Netflix, whatever. Let's dive in and answer the questions that we all want to know in regards to our overall portfolio. We also have a special gift for you, so you don't want to miss it. We'll be right back. Show's called Your Money, Your Wealth. Hey, welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson, Alan Clopine. We're talking all about market volatility and what the heck should we do with our overall money. We have Brian Perry. He's a chartered financial analyst, director of research, executive vice president, Pure Financial Advisors. He'll be joining me momentarily, so you don't want to miss that. But before we get to that great interview, let's see how you did on the true-false question.
You should periodically rebalance your portfolio to increase your overall rate of return. Joe, I would say that's generally false because stocks do better than bonds in general. And so if you're not rebalancing, you're going to end up with more and more stocks. Take a look at this slide here. This is a case where someone rebalanced for the last decade, let's just say, and this is stocks. That's about 75% stocks, and bonds is about 25%, give or take, right? Now, if you don't rebalance at all, you end up with a lot more stocks. You actually, as long as the market's going up, you're actually going to increase your rate of return. But here's the problem. The problem is if you need cash flow from your retirement and you're pulling money out, you may be pulling money out when you have too risky of a portfolio. You may be pulling money out when stocks decline, and then it's very hard to recover. So I think, Joe, that's one of the things people don't really understand. Rebalancing is to maintain your risk profile.
Yeah, I mean, it creates discipline in the overall portfolio, right? Because when stocks go down, you're purchasing more stocks. And then when stocks go up, you're actually going to sell those stocks and rebuy the bonds. So you're managing your overall risk. If the market just continued to go up and was never volatile and never went down, then you would never rebalance because it wouldn't make any sense because you're always going to make money. But we don't know when the market's going to be volatile, right? So that buffer is there to protect you. It's just to make sure that the risk parameter of your overall portfolio is intact and give you that discipline, because when stocks go up, we don't necessarily want to sell, right? Because, hey, why would you sell something that's doing really good? Or when things go bad, you don't want to buy. Why am I buying this dog? So a rebalancing strategy just helps keep that discipline in the overall portfolio.
Yeah, no question. I guess now we're going to get into investments with Brian Perry.
Yeah, well, you know what? This is great because we have Brian Perry. He's, like I said before, he's a director of research at Pure Financial Advisors. He wrote a great book. It's Revamp Your Overall Retirement. You know, what the heck should you do in time of crisis? We're going to give that book away for all of you as our special offer today. So let's just bring Brian in right now.
Hey, it's good to be here. We have so much going on, right?
Yeah, to say the least, to say the least. Well, no, we really appreciate you joining us today. But let's start here. I guess it's 2020. halfway through the year, thank God. What should people be thinking about? Should they be switching gears, changing investment philosophies, or if they got out, is it now a good time? I mean, let's talk about what happened and what should people be doing?
Yeah, I mean, well, there's a lot wrapped into that, right? And what happened is that the market's gone crazy, right? I mean, coming into the year, I don't think too many people, if you asked for what they were worried about, they would have said coronavirus. And yet, you look at the stock market, and we got off to a pretty good start, and then come March, the market collapsed, February into March, and then subsequently we've had a pretty good recovery. And a lot of that's been driven by what? By coronavirus, right? And as cases ramped up, we saw an increase in fear, and people were selling, right? Flight or fight. People flew, they sold, and they ran away. And then since the government stepped in, and this is something that we can talk some more about, but there's been a ton of government support both from the Federal Reserve as well as from Congress, and that gave a lot of comfort to the markets. It cushioned the economy to a degree. We still have a really bad economy, but the market started to recover, and we've actually had a pretty good couple months. The last quarter was one of the best in decades.
Let's talk about a few different things here, because let's unwrap this a little bit. Let's talk about the Fed. Okay, the Fed has stepped in almost from day one. You hear a lot about it, but people, I'm like, what does it mean? What are they doing?
Yeah, and one of the things that's a little bit confusing about the Fed is a lot of what they do has to do with, it deals with the plumbing of the market. So a lot of times they're in there working on corners of the market that the average individual may not be investing in, commercial paper and stuff. But that really is what keeps the markets flowing. It's what allows companies to fund themselves overnight. And the Fed really learned a lot from 2008, 2009, where arguably they were a little bit slow to react. But once they did, they managed to stop the free fall of the economy. So this time, yeah, bang, they jumped in on it. They lowered the overnight interest rate, the overnight lending rate, to 0. And then they came in and they provided additional support to things like commercial paper and money markets. They also, for the first time in history, they got new authority to purchase corporate bonds and high yield bonds. And when the economy slows down, no business has really run a scenario where their revenues go from whatever they are to 0, right? I mean, that just doesn't exist when you're stress testing. So there was a very limited ability for companies to fund themselves. The Fed came in and really put a floor under those markets, and you saw a lot of high yield bonds, corporate bonds really recover or at least stabilize. You also saw longer term interest rates come down quite a bit, which allows more Americans to buy homes, refinance. I mean, the housing market's doing pretty well, in part because there's not a lot of supply, but also because mortgage rates are so low.
So, hold on. With that, there's got to be some negative downside, right? So you're talking positives, but we got 0 interest rates. So if I'm a retired investor or if I want some bonds in my portfolio, what is that going to do to my overall portfolio with very little interest rates?
Yeah, it's going to hurt it. I mean, no ifs, ands, or buts. I've heard people say that it's really just a penalty to savers. Right? So if you think about it, for the better part of a decade after the financial crisis, interest rates were at 0 and retiree savers had what we're talking about. You finally got some higher interest rates where people could get some return, and now that's reversed. And so what the Fed is doing is they're forcing people to take more risk. Right? I mean, it sounds odd, but that's really what they're doing. They're forcing people that maybe they would have bought a CD for income. Now they need to buy a corporate bond. Maybe now they can't get a corporate bond because interest is too low. They need to buy a dividend stock or some sort of growth stock or something like that. So they're forcing people out the risk spectrum, which supports overall markets, but also penalizes people that just want to lock the money under the mattress. That's really not feasible right now if you want to be successful.
And then you look at the stimulus. You got trillions of dollars with the CARES Act that came in to help employers either keep employees. You have unemployment benefits that were spiked because there was a little bonus there to help people, the PPP loans. I mean, the list goes on of all the relief that happened. And we'll probably see a CARES Act 2.0 with now, smaller businesses shutting down. What do you think that will have on the effect of the overall markets and the economy long term?
Yeah, well, there's two things. In the short run, I think they did absolutely the right thing, because when the patient is critical, you do triage. You do what needs to be done to help people that are suddenly out of work and stuff like that. So I think that's a large degree of the reason why we've seen stock markets recover. And while unemployment claims are still very high, they're lower than they were, right? Longer term, though, you've added $3 trillion to what was already a high deficit, right? And what happens? Well, when you have a deficit, it adds to the national debt, and we now have this very large national debt projected to continue to grow. In the short run, that's not an issue, because we talked a moment ago about interest rates being so low. So the actual cost for the government to pay the debt is not that high, because although the debt is high, interest rates are low. Further out, at some point, though, the bill comes due, just like if we all had personal debt, right? There's 4 ways to satisfy that. You can default on the debt, right? I don't think that's going to happen, despite what some doomsayers would say, right? You can grow your way out of the debt, but that's probably being overly optimistic. I think the 2 most likely are you inflate your way out or you tax your way out. And I think that's the future that we're looking at. And fortunately, there are things you can do to protect against both of those.
So I guess looking longer term for the average investors, making sure that, hey, there could be higher taxes on the rise, there could be a little bit higher inflation on the rise.
Yeah.
And then, we don't have a crystal ball, we don't know what's going to happen, but at least you can start strategizing a little bit and playing the defense mode on things that you can control.
The bottom line, though, Joe, is that it's not as bad as it seems. The economy is poor, and certainly we have a lot of people, record number of people out of work. But as this chart shows, if you look back over history, the higher the unemployment rate is, the better stocks have done. The worse the economy is, the better stocks have done. And so although times are tough, again, buckle up. We're going to have volatility. We haven't even touched on the upcoming election. But ultimately, for a lot of the reasons you and Al talked about, as well as the economic data, stocks tend to move higher over time, despite the headwinds we're facing right now.
So do the opposite of what you're trying to probably think.
If you go contrary,
when things are bad,
yeah,
right, just do the opposite. Stay the course. Don't do anything. Buckle up. To help you out with this, Brian Perry wrote a great book. It's called Revamp Your Retirement, Strategies to Do in Time of Crisis, and there's no better time to do this. You can download it for free. Our gift to you, it's our special offer this week. Go to yourmoneyyourwealth.com and click on that special offer. Get the ebook. It's a quick read, but there's a lot of really good nuggets, and there's some strategies that will probably save you from yourself and maybe save a couple of bucks in taxes and a few other things. So, Brian, appreciate it. Thank you so much. We'll be right back. We've got Big Al coming back in. We're going to answer your email questions and a lot more. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson, Big Al, Clopine, talking about moves that you got to make in regards to the markets, to your financial plan, to your emotions, and everything else in between. We're going to wrap the show up, but before we do that, let's see how you did on the true-false question.
A 30-year-old who invests $600 a month at a 7% rate of return will be a millionaire at age 65. And that's actually a true statement. You want to be a millionaire, start at age 30, invest $600 per month, 7%, you get to $1 million. But Joe, a lot of times people come to us and they're age 50 and they haven't even started.
But so, what's $1 million in 30 years?
Well,
you can buy maybe a gallon of milk.
It's better than nothing, right? But here's what I want to talk about is when someone starts at age 50 and they don't really have anything, as long as you could save about $750 a month by the time you get to age 65, 15 years, then you'll have about almost $250,000. So that's better than nothing. That's actually more than most people have. So what I would say is it's never too late to start, Joe.
Yeah, without question, but there's always reasons for not to start, such as the coronavirus. It's looking at, hey, I don't know if I should start investing now. So Al, let's break down some moves. Let's just make this real short, sweet, and simple of some current moves that people should be doing with their overall money.
Yeah, I think first of all, Joe, consider your exposure to the market, and especially in times where it's volatile, it's make sure you don't have too much risk or not enough, depending upon your situation. Relook at how much you should be invested in the stock market. That's kind of number one. Number two, I think, is invest globally. If you look at the last 10 years, the U.S. market has done better than the international market. However, the 10 years before that, it was exactly the opposite. Investing in low-cost funds or ETFs, you've got several choices, several ways to invest in your market portfolio, but you might as well pick lower cost funds because then you get to keep more of what you make. Another one is what we call rebalancing and tax loss harvesting. I want to talk a little bit about tax loss harvesting because it's really a way to basically save on taxes, which ultimately puts more money in your pocket. Here's the concept. The concept is the market tends to trend up, and we just had a period of time where it went down, and then over time it trends back up. And so what I would tell you, what most people do, they invest about here, they get really upset, they don't think about it, they end up here to here at the end of the year, looks pretty good, right? But you missed an opportunity. And here's the opportunity, is when your investment, it goes down, you bought it here, now it's here, you can actually sell it, you've created a tax loss. That loss you can use as a capital loss against any capital gain on your tax return. And to the extent you have more losses than gains, you can actually carry it forward in future years. So you sell here to create a loss, very important, you buy something similar so you're still in the market, you will receive that recovery. In the meantime, you're roughly in the same place as you would have been otherwise, but now you've created a tax loss that you can use against your future capital gain tax liability.
Yeah, I think that's a key point, Al, is that when you're looking at this and you're saying sell, it's like, well, we've been telling you all day not necessarily to sell when the markets go down. But this is selling and buying something similar. You're still in the market to capture that loss. You can buy back that same security in 31 days. It's a wash sale rule, but it could really enhance the overall portfolio in regards to tax efficiency. Hey, it is that time, Alan. Let's switch this program, this beautiful program we have, to the experts. Let's ask the experts. Let's get your email questions.
My wife wants to invest in ultra-short bond ETFs during the pandemic. Are these a good choice with the volatility that we're seeing in the market? This is from Connor in Vista. Well, I would say ultra-short-term bond ETFs, that's very good for reducing volatility and not losing your capital. Joe, it's not very good, though, for increase, future investment return.
Yeah, I mean, it really depends on what the goals are, right? If you have short-term bond funds, you're going to have liquidity. You're not going to have a huge rate of return, but you're also not going to be participating in market returns or losses. So maybe it's a good opportunity or for a small portion of his portfolio, but it's looking at, people like to pick, just certain investments.
Should we do this? Should we do that?
Let's buy this and let's buy, instead of having a cohesive plan.
Yeah, and so I do agree. Now, a short-term bond fund, ultra short-term, can be a good part of your portfolio, but not the whole thing, certainly, because you're not going to get much rate of return.
Let's go to question number 2.
I'm a single mom who is short on cash since I got laid off from work. Is borrowing from my retirement fund a good way to keep up with my mortgage and car payment with the new CARES Act rule changes? This is from Laura in San Marcos. I'll start it, Joe, by saying borrowing or utilizing your retirement funds for current expenses is usually not a great idea. However, let's be realistic. Sometimes we don't have any other choices.
Yeah, I mean, the CARES Act has given the ability to tap into retirement accounts, loans, for instance. So they increased the loan amount to $100,000. They deferred payments for a year, fully vested. Before it was $50,000 max or half the overall account, whichever was higher. So now it's $100,000 fully vested, so you could take a loan from the overall account, defer the payment for a year. Hopefully we can get back on our feet, then you can pay that back. Another way potentially is to take money from an IRA. So if you don't have a 401k that has that loan option, you can take money from an IRA up to $100,000, and then you can pay yourself back over a 3-year time period. So that gives you some liquidity, gives you some capital that you can use on, and then you can pay that IRA back over 3 years. Or if you want to keep that cash outside of the retirement account, you can pay the tax over a 3-year time period. So a lot of flexibility with the CARES Act. They understand that people probably need a little bit of cash if you're laid off, furloughed, reduced hours, all sorts of different things. So
well, and that's why they came up with some of these rules, and they are pretty effective. But realize that this is not our recommendation. We would really rather have you find other sources of capital to be able to cover your expenses, cut your expenses, whatever you need to do. But again, if you're not able to, then this is at least one way to do it.
Let's see what we figured out today. Let's go to the peer takeaways. First things first is that the importance of controlling your emotions. I understand we've been doing this a long time, and when markets get a little bit jittery, of course our emotions get jittery. It's just controlling that. Rebalancing though, when markets go like this, we can rebalance the overall portfolio, take advantage of the tax law as best you possibly can. And then you just got to make smart money moves. Just understand where you're at right now and do the best thing possible with what you got. So again, the best money move that you can make this morning is download Brian Perry's book. Go to yourmoneyyourwealth.com, click on that special offer. It's Revamp Your Retirement, a whole bunch of good stuff that you can do in a really bad time. Something like that. So thanks again for joining us. We'll be back again next week. For Big Al Clopine, I'm Joe Anderson. Have a wonderful, wonderful morning.